We've seen about 7 trillion erased in values of equities in China and Hong Kong since their peaks in early 2021. Jared Blikre has a closer look at some of the moves that we're seeing. Jared.
Blame the short sellers. That is where we are in this playbook. And we're seeing the Chinese Securities Regulatory Commission come down in quite a hard way on not only short sellers, but also sellers that are engaged in a market neutral strategy. So that's long sum, short sum. At the end of the day, all this means is the Chinese government has lost complete control over their stock market. Now, we are seeing some reaction to the upside here. Not a lot, but we've seen this before. But you take into totality of the year to date, and these are the members of the NASDAQ Golden Dragon China Index, we're seeing some serious losses here. I'll sort by performance. And you can see the middle stock here, the median stock is actually down 20% or more. And if I go back 1 year, it gets worse. You can see the median stock down about 43, 44, 45%. So almost half of the value wiped off for the median stock here. Now, what can the Chinese government do going forward? Not a whole lot. They've been engaged in a piecemeal strategy trying to target specific areas of the economy, and that includes real estate. It also includes the stock market, but it has been failing, and we can see that evidenced by these numbers here. The real problem for the Chinese government is that if they stimulate too much, their currency gets devalued, and that's what they're trying to prevent, because then you get capital outflows, all kinds of negative knock-on effects then. But here's the US dollar versus the Chinese yuan. If it's going higher, that means the yuan is weakening, and it has been weakening. And by the way, those are multi-year highs up there. Let me put a max chart in. These highs are what we're up against here. And the thinking is that if the market were to go higher, yuan weakening, that would only accelerate to the upside. So that's what the Chinese government is trying to prevent. But if you want to see any inkling of how much China is a drag on emerging markets, just look over the last 3 months. Here's EEM. This is iShares EM ETF versus iShares EM ex-China. Ex-China is up 7.6%, still underperforming the S&P 500 of 13%. But nevertheless, there are some gains out there, but you got to remove China from the equation.